Good morning, Campbell McCreary here, Amvest Capital in New York City. Welcome to the Amvest Capital Inc. live webinar with Aurcana Silver Corporation. Aurcana trades on the venture as AUN and on the OTCQX as AUNFF. Hope you'll enjoy today's program. It will be available in replay, on-demand replay about an hour after this event. You get that link in your email, and also it will reside at amvestcapital.com/replays forever. Amvest, of course, is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. Please note, please read this disclaimer carefully. This call is for informational purposes only. Very pleased to have with us Kevin Drover, the president and CEO of Aurcana, director. A lot of exciting things going on in Colorado these days, and you all would have seen his Monday's press release. So, Kevin, if you want to turn on your webcam also, please update us.
Okay. Well, glad to be here, and thanks for having us, Campbell. I'm going to put up my, can you see that?
I can, just slideshow mode, and I think it'll work.
Okay, so we're ready to go.
See you later.
Okay, well, thank you very much. Seem to have lost my, just bear with me a moment, please. I seem to have lost my, oh, there we go.
There we go.
Well, good morning, everybody, and glad you could attend. It's a very special time for Aurcana right now. We're just getting back into the mode of being a producer again. We put a press release out on Monday, basically saying that we're commissioning our Revenue-Virginius mine with ore, and we're in the process of doing that right now and ramping up to full production. I'm going to take a few minutes and go through the presentation. For those of the people that are attending here and don't know the story, just to give a little bit of background on where we were, where we are, where we came from, that kind of thing. So off we go, the usual disclaimer information. Aurcana's got two projects, two assets. Both are in United States, Tier 1 jurisdiction. The flagship of the company is the Revenue-Virginius mine, which is located near Denver, Colorado. We're about a 7-hour drive from Denver, or a half-hour flight. But it's near Ouray, and it's just up in the mountains, in the San Juan Mountains. And this is the one that we just put back into production. The second asset we have is the Shafter mine, about a 3-hour drive southeast of El Paso and a half-hour drive south of Marfa, Texas. The Shafter mine is fully permitted, currently on care and maintenance. It has a 1,500-ton-a-day mill on the property. We're currently doing some work on updating the resource there, where we're looking to do a small drill program later this fall, and with an eye to doing a feasibility study in the first half of 2022. And pending, of course, if it's a positive outcome from that feasibility study, we'd be looking at putting it back into production. I'll tell you a little bit more about that later. Right now, the real focus is the Revenue-Virginius mine in Colorado. So just a little bit of an overview. We've got all of our people. I got a full management team, experienced management team. All of us are here in Colorado at the moment, including myself. I moved down from Vancouver in December of last year to be close to the action here. Easier to make decisions and a lot less time in quarantine trying to go back and forth across the border, which is what I was doing for a lot of 2020. So we're going to be in production. We're ramping up production right now at the Revenue-Virginius mine. We're going to be about 81% silver by revenue. We do have some byproduct credits such as gold, lead, and zinc. Some fairly high-grade materials. The mine itself, on a silver equivalent basis, is very high-grade, 37 ounces per short ton. Our cost to production, we're thinking that we're going to be right around $10 per ounce of silver after byproduct credits once we get up and settled down. Between now and the end of the year, we're thinking more like between 10 and 12. As you start these things up, you're focused on getting your material to the mill. You're focused on getting your product, your recovery, and then you start to look at costs. So it'll be, a little bit later in the fourth quarter when we really focus in on the cost kind of thing. And we've got what I think is just a world-class potential to grow this mine here, and I'll tell you a little bit more about that. And of course, the Shafter project is fully permitted. It's at a PEA stage, 100% silver by revenue, and it's got some pretty good exploration potential as well. Just a picture of the mill itself, to give you a little bit of a view of it. It's actually located underground. We're up in the mountains at about 10,600 feet, and we're in avalanche country. So the mill was put underground. It's quite an excavation. I'm not sure you'd do it in today's world, but it's quite adequate, as a matter of fact. It's a flotation plant, crushing, grinding, flotation, concentrate produced. We produce a lead and a zinc concentrate. Trafigura is the off-taker for that. They're taking all of our concentrate, and they pay us 95% of the value of the concentrates at our gate. So, working capital issues are a lot less problematic. Tailings is dry stack tailings, filtered dry stack tailings, best available technology. Just a little bit of an overview of the property itself, where, like I said, we're high up in the mountains. Very small footprint. We practically only have a couple of office buildings and storage buildings on site. Mill is underground. Mine is also an underground mine. So our tailings storage is going to be right here in the foreground. And as I say, that'll be dry stack tailings. Our water treatment system is fully installed and operating. We're meeting water quality standards quite nicely. So we don't have any worries with any of that. Just a little bit on cash flow, just a comparison of operating cash flow margins, what we're anticipating anyhow, and silver revenue percent. As I said, we're right at 81% of our revenue is derived from silver, as compared to some of the others that's not quite. And the cash flow margin, as with the 37 ounces per ton grade that we have, and our all-in sustaining cost per ounce, we've got quite a cash flow margin. So we're anticipating some pretty good things. Just a couple of other on valuation: operating cash flow yield, enterprise value to EBITDA, peer averages on the price to NAV, just to give you some kind of a look at where we sit in some of these comparisons, so that you can draw your own conclusions. Where we came from, I guess, the Revenue-Virginius mine, we did the deal, Aurcana did, and bought this in 2018, right at the end of the year, December 27th. And in 2019, we started out raising our money, raised some money late in the year, and then finally in 2020, we got ourselves pretty much fully financed. We took on a debt facility from the Courier, 28 million, and then we raised some money in 2021 to give us sufficient money to get back into production. So, just a little bit of a timeline. I'm not going to spend any money or any time on this kind of thing. It just give you a little bit of an idea of where we came from and where we are right now. So we're right in the fourth quarter, or I guess right at the last month of the third quarter, ramping up to production as we speak, looking to be in full production through the fourth quarter. So again, just a little bit of a timeline on how we all got there, and so we're starting production in 2021, but we're not stopping there. The design of the feasibility study that we're putting this into production under that feasibility study. The design feed rate is 270 tons per day, and with that feed rate and the 37 ounces per ton that we've got, our production is about 3 to 3.5 million ounces per year. But in 2022, we're looking at increasing that production rate. Our milling facility is designed for just over 500 tons per day. So we're starting up at 270. All the economics that you've seen on this company is based on that 270, and it's quite intriguing, and it looks really good. But at 400 tons a day, 500 tons a day, it looks a lot better. So in 2022, we're looking at increasing our throughput rate from the mine and to the mill by about 100 tons per day. So that will take us from that 270 to about 400. And that takes us to around 4.5 to 5 million ounces per year. In 2023, we're looking at going up another 100 tons a day to the full 500. And that should put us into 6 to 6.5 million ounce production. In 2023, we are looking to have the Shafter project, pending a positive feasibility study. We're looking at having the Shafter project go into production as well. As I said before, there's a mill already there. The mine, there's a lot of development already done. It's fully permitted for production. So if the economics work for us, which we believe they will, we'd be looking at putting it in production in 2023 at the rate of somewhere between 2.5 and 3 million ounces, which would put us up in that 8 to 9 million ounce production range and bring us back into mid-tier producer status, as Aurcana was at one point in the past. So there, just basically what I just said. This is what we're looking at over the next little while. But we're not going to try and run before we can walk. In the rest of this year, we're going to focus on getting our metallurgy, getting our metallurgy, our productivities, our throughput, and our costs. And then come 2022, we're looking at starting to ramp up. And this is all about development in the mine. You just can't, ramp it up to 400 tons a day. We have to get that development done far enough out in front of us so that we can sustain that production as we grow ourselves. Just a little bit on the company itself, roughly 278 million shares outstanding. Market cap right now is around that 250 million. We've got about $12 million in the bank as we speak right now. We believe sufficient to get us to cash flow positive. Debt, we've got a $28 million debt facility from McCurrier. And we had a 1-year grace period that is up on in mid-December. Our first payment is due in March of 2022. So we're in pretty good shape as we speak right now. Just a little bit on the assets itself, and this is a relatively important slide that we've got here. We own 9 major veins in this particular area of the San Juan Mountains, and we're focused on one of those 9 veins, which is the Virginius vein. This one right here, if you can see where my cursor is, and this is the long section right here. All of these 9 veins have been in production at one point in time in the past, over the last 150 years kind of thing. But the Virginius vein has been typically the most important one, has been the highest grade, best producer, and so on. This mine ran from about 1875 to 1912 continuously for 46 years, and it produced 25 million ounces of silver. Profitable every year, even at silver prices down in the 30-cent range. So it's been a very prolific producer over the year. We own 16,000 feet right now of the Virginius vein. Of that 16,000 feet, all of our reserves are contained in about 3,500 to 4,000 feet of that 16,000. So we're open right along strike all the way here to the north and also to the south. We're going to be mining this area right here, the purple, the green, and the pink. This is our current 7-year mine life sitting in just right here. But the prospects on this is just enormous. We can trace the vein on surface for this full 8,000 feet over on this side. It's very, very difficult to drill. We're up in the mountains here, almost impossible to be able to set a drill that we can get a proper aspect to pierce the vein itself. So most of the work that we're going to do from an exploration perspective is going to be drifting underground out on the various levels as we mine up in this particular area right here. These other veins, the Atlas Cumberland, the Klondike, the Wheel of Fortune, the Yellow Rose, they're not all shown here. But we have access to all of those veins through this black line that you see here. This is our main tunnel that access the Virginius vein and all of these other veins as we come in through them. So in fact, right now, we've just recently slowed down on this and we're focusing more on the development up here. But we did have a crew on the Wheel of Fortune doing development underground, and we've done about 400 feet, I believe. We're getting ourselves in a position where we can do a little bit of drilling down here because we anticipate that there is some very high-grade silver areas in this area right here, along with some significant gold values. So we're going to be focusing back on that just as soon as we can get a chance. I'll just jump ahead a little bit. This is a blow up really of this area that you see right here. So this is where we're mining right now. Our infrastructure development over the last 8 months, we've been putting in our number 1 raise, number 2 and 3, excuse me. The number 2 will be our ore pass coming down, and number 3 will be our waste. The number 1 will be, it's basically a hoist shaft elevator to move men and materials, and ultimately we'll be all the way up right here. But right now we're mining on this level right here, the 1800 level. And this is about 1,500 feet from this point right here to this point right here. And so this is our first focus. We're going to be mining right in this particular area. So we've, on this plan view right here, it's not updated, but we're drifting to the south and we're drifting to the north as well. What we're seeing there, and in our last press release that we put out, we put in some grades that we are seeing. So we've developed along right here, and we sample basically every 6 feet, every 5 to 6 feet we're sampling. We're sending those assays out for assaying results, or the samples out for assaying, but they're very, very slow coming back. The industry right now is overwhelmed a little bit with assaying. There's a shortage of litharge, which is needed for precious metals assaying. So very, very slow to get materials back. But we did get some assays back in the area, just kind of right along right here, about, I think it was 78 feet of assay results that we got back. And those came back undiluted at an average of 54 ounces per ton, fully diluted to our mining width, I think was about 33.9 ounces per ton. And that compares to what the model that we have. And we have a geological model because we did some drilling. We have some holes down around here and some holes up in this area. And that area was supposed to be relatively low grade, and we knew it was low grade. So it was supposed to be about 26.9 ounces per ton, but the vein width at that area was about 0.23 feet per ton. So the average diluted grade was quite low at right around 4 ounces per ton. So what we're seeing, what all that means really is that we're seeing higher grade right now, at least based on those limited assays that we have, than what we had expected. So that bodes well, I believe, and you know, we'll certainly have more releases of that information as we get more assay numbers back, you know, from the various assay labs. So it's going very well. So we're going to be mining the 1800 first, then we're moving up to the 1500, then we'll move up to the 1200, and we'll move up to the 900 and so on. And while as we get toward the end of that, we're going to be also developing down here below the level, the haulage level, which is the 2000, to prepare this area for mining as well. But we don't have a lot of exploration information out here to the north, but as we develop out here on the 1800 level and the 15 and the 12, our intention is to just keep going. If the vein is in front of us, we're going to just keep mining it. And we believe that the future of this mine, at least the next 20 years, lies right in this particular area right here and this particular area back here, just on the Virginius vein. And that's not taking into consideration the other 8 veins that we have. So, you know, we're certainly going to be putting some money into exploring out this way over the course of the next, you know, 6 to 12 months. So we'll have to stand by for that. So a little bit on Shafter itself, PEA results. That was done by MDA out of Reno. Pre-tax NPV at 57 million, IRR 112, all-in sustaining cost of $11 per ounce. So there's no byproducts. So it's reasonably decent. We've got a fair bit of work to do here. As I said, this is at a PEA level. We're not going to try and put a project into production at a PEA. We'll do a feasibility study and nail this down a lot closer. We do expect to have a new resource out, an updated resource on this within the next month or so. Just to summarize a little bit, I'm not going to, you know, we've spent a fair bit of time on this, but we're in production. We are going to be a producer in the next couple of weeks. We haven't made any concentrate just yet, but we're debugging the mill at this stage of the game. The grades are looking good, at least what the feasibility study says at 737. We're seeing higher grades than that. We anticipate our costs are going to be still around that $10 per ounce on a pure silver basis. We have some significant upside on our exploration potential to extend the life of mine. We've got the Shafter project in Texas that we can bring online as a second project. So I think we're in a pretty good place. So stay tuned. We'll be keeping you posted. With that, I'll stop.
Excellent. You ready for some questions?
I am, if I can. Yeah, here we are. Yes, please.
Okay. Thank you all for sending in your questions, and then we'll have our Amvest questions. Given you should attain about 50 million in free cash flow over the next 12 months, you could announce to commence 1% quarterly dividends. Alternatively, you could announce a stock buyback program. You could announce pursuit of a higher U.S. listing like NYSE or Amex. Any of these announcements could dramatically enhance shareholder value. What are your thoughts? So,
well, we have a number of competing needs for the cash flow. We have a debt that's at, you know, once we get up to full, right now it's at 14%. Once we achieve 3 continuous months of 400 tons of concentrate, lead concentrate per month, that drops down to 10.5. But right now it's quite expensive. So, you know, we got a couple of things we could do with that debt. We can certainly use the cash flow to pay it down, and I think that would be a very good use of cash at the moment. We might be able to get a cheaper debt, you know, being a producer kind of thing. We have exploration that we want to do. Currently, we have a mine life of 7 years, give or take. We want to get that up at least to 10 years. So we want to put some money into exploration, those kinds of things, and I think that would add significant value. We have the Shafter project that we're going to want to put in production. We're not exactly sure how much that'll cost. The PEA under that scenario was about $22 million. And, you know, there's the dividend issue. So from the perspective of how we're going to divvy up that cash flow, I think it's a little bit too early to say. I don't want to get too far out in front of or too far behind the cart, the cart without having the horses in front or something like that. But I think that's a decision the board's going to have to make as we get ourselves into production and we actually see that cash flow materialize.
Would there be an opportunity to purchase land adjacent to the property?
Yeah, there's a number of different opportunities there. We're the only game in town right now. There's the Camp Bird, there's the Orbis claims, there's the Ruby Trust that we've talked about in the past. And to be very honest with you, we're in discussions with all of them. We've not done anything just yet. We want to get ourselves into production and make sure that we've got cash and those kinds of things. But I think, you know, because we're here, because we're permanent, because we got a mill, because we're now producing, I think we have the best opportunity to secure these various assets around us.
Are you expecting grades to remain consistent over the long term, or could there be large fluctuations? What is the range you would expect?
Well, this is a deposit that it's a narrow vein deposit, and it pinches and it swells. And yeah, we do expect some fluctuations, and some of it could be dramatic fluctuations on a day-to-day, shift-to-shift basis. But the Virginius vein is very consistent and continuous. It's from an investor's perspective, looking at this, you're not going to see it. You know, we're going to be pretty much consistently producing because we have a number of different stopes. If you have low grade in one, we can go to another one on in a different area kind of thing. But from a management perspective, from us geologically, internally in the company, we're going to see fluctuations on a day-to-day, shift-to-shift basis, just by the very nature of the narrow vein, kind of nuggety. We get areas of the vein that are extremely high, you know, 400 ounces per ton, 300 ounces per ton. And some, you know, are low grade, like this 26 ounces per ton area that we're supposed to be in. But overall, I don't think it's not going to see wide fluctuations in our production over the course of a year.
What is your underground water inflow? Can the mine create a scenario that results in the water breakout like the Gold King mine several years ago? And for those of us who don't know what he's referring, maybe you can bring us
yeah in. Well, just a little bit of on the Gold King. Of course, Gold King was bulkheaded off, and so there was the water was allowed to accumulate inside the mine in the mountain, and it was hydrostatic pressures and so on. But some people went in there and started poking at those bulkheads, and all that water in the mine was flushed out and then down the river. No, we don't have any kind of a scenario that's like that at all. We do not have any bulkheads. All of our groundwater is free flowing. We're allowed to discharge it. It goes through our passive water treatment system, and we meet, you know, it's more stringent than drinking water standards. So we meet those standards, but we're not holding any water back behind bulkheads.
Okay, very good. How long to pay off the debt?
Well, it depends. Yeah, if we want to, I mean, pay it off in a year. From, you know, you look at the price of silver, we ran our numbers at about $25 an ounce, and this thing is north of $50 million after tax free cash flow. So that's the kind of money that we've got to be able to apply to the debt if we wanted to do that. Now, as I said before, you know, there's some competing needs for that cash. So as a board, we'll have to sit down and decide what that best use is.
Based on the claim map and orientation of the claims, there appears to be some north-northwest trending veins as well. Are these potentially productive and open to exploration?
I'm not exactly sure which ones he's talking about, but certainly the Terrible vein, the Yellow Rose, the Wheel of Fortune, all these veins have been past producers, and we expect to see them produce again.
Long term, if other veins prove fruitful, how would they eventually be processed? New mill, expansion to existing mill?
Well, this mill, we could probably expand it a little bit, but because it's underground, it's a very limited expansion kind of thing that we'd be looking at. We do have the Camp Bird mine that's 900 feet below us is kind of sitting there, not doing very much right now. We're very interested in acquiring that if we can do some kind of a deal. It has a permitted tailings pond, and it's not a pond, it's a stack, but it's fully permitted. That would give us about 25 years of tailings capacity, but it also has an area that's been permitted as an area that you could put a mill. So if we are lucky enough to have, to be able to mine in excess of 500 to 1,000 to 1,500 tons a day, that would be, the Camp Bird mine would certainly help out in that particular respect. So yeah, to try and expand the current mill, not really practical in an underground scenario, so we'd probably be looking at building another one.
Okay, thank you. In the past, Aurcana has sold oil and gas rights from non-core assets. That's going back a ways. Does the company still retain other non-core assets?
We actually didn't sell them. We leased them, and we still own them. We still own those. We have a number of assets in the Permian Basin, in Oklahoma, and those are still with us.
Okay. Could we expect the conversion of warrants to mean no need to raise additional capital?
Well, it'd be nice to have those warrants come in, of course, and that would certainly help us. Right now, as of today, I've got $12 million in the bank. We're ramping up to cash flow positive. I don't see us going out right now and raising money.
Okay. When will you start making royalty payments? What kind of schedule would there be?
Royalty payments start as we start production. So that's all built in, and anybody who's looked at the feasibility study, they're all built into the economics of that. So that just happens automatically.
Excellent, thank you. Adam Graff, are you there? Adam Graff? Is not here. Okay. Has COVID affected your work schedule? Did it ultimately get and going into production? Did it ultimately slow things down? Are you behind?
No, we did get behind. We're about a month behind of where we said we were going to be, probably in May, I think it was. But that was not because of COVID. We've had some people with COVID, but very, very little. Most of all of our people, I believe, are vaccinated. So we've got around that one quite a bit. But our delays that we had are mainly related to the 1800 level and what we thought our efficiencies would be as we opened up that level. It took us longer. It was more congestion. You can't work because you cross-cut into the vein. You've got a 6-foot opening. You're trying to go to the north. You're trying to go to the south, and you just don't have enough area to be able to become efficient with 2 crews. So that cost us a bit of time, but not the COVID really hasn't cost us any grief.
Do you imagine your company is an attractive takeover target, or are you an attractive consolidator?
Well, yeah, for sure. I think we're a target. There's no doubt about that. We're a tier 1 jurisdiction. We've got 2 projects, both fully permitted, both with mills on continental United States. So I think that is, there's a lot of appetite out there for that. What we've been doing so far, and we've got some pretty good organic growth opportunities, with what I just outlined a little bit earlier. But of course, if opportunity comes along that makes sense for the shareholders of this company, then we're going to take advantage of any of those opportunities that really make sense for us to grow, and we'll look at it on an individual basis kind of thing, whether it be us acquiring or being acquired.
Mm-hmm. Any near-term potential hurdles that could cause delays, and how are you mitigating these? So maybe fundamentally, what's the checklist of things that still need checking and double checking as you ramp up in September?
Yeah, well, right now it's, of course, commissioning your milling facility after you put as much new equipment in as we have is always a little bit of a challenge. So nothing goes as smoothly as you anticipate that it will. But right now, we've got our share of gremlins, whether it be electrical ones or mechanical ones, but we're working through all of those, and I don't anticipate any major issues with it. It's normal stuff. So it all runs. We've run all the pieces of equipment. We've put some material through it, so we're pretty happy. The one area, of course, that's critical to us achieving our cash flow positive and our numbers is our development underground, and that is the focus that we've got right now, is getting those efficiencies to where we can get the development far enough out in front of us that we can assure ourselves that we can maintain that 270 tons a day. So right now that's going very well. There's been some issues there, as I said, with congestion on the 1800 level and developing the first openings for the stope, but we're overcoming all of those, and I really don't anticipate many issues going forward, but you can always have some, of course.
Okay, I'm going to pass this over to Adam. Had some technical difficulties. Hi, Adam.
Morning, Adam.
Hey, can you hear me okay?
Yes.
Can you hear me? Great.
Yes.
Great.
Okay.
Kevin, I think you alluded to development as a key hurdle, and so what comes to mind is stope inventories, and keeping sufficient stope inventory ahead of you so you don't have any production interruptions.
Yeah, exactly. So on the 1800, we've got roughly 1,500 feet of strike length on that. Our first stope is about 750 feet wide or long strike. We're in the process right now. We're going to bring that first one on in phases. So the first phase of that stope will come on, that first 750 feet will come on in about 10 days from now. And then very quickly behind that, phase 2 comes on, and then very quickly behind that, phase 3. And that gives us that about 500 feet of strike length to be able to feed the mill. Meanwhile, our crews are still pushing out to the north on that to finish the first plus put the second stope. So into late October, we're looking at having 2 stopes available on the 1800 level. Right around November, we're looking at being up on the 1500 level and starting development of 2 stopes up there. So we're looking at having 2 stopes available to feed the mill, and then 2 stopes prepared further out in front of us early in 2021. We can pretty much feed the mill with 1 stope. It gets a bit congested and whatnot in there. So that's why we'd like to have 2 online. But I think we're going to be fine right there. And certainly by January, we should have 4 stopes available and in pretty good shape.
Kevin, you're doing on stope development, correct?
That's correct. Yep.
And so if while you're only accessing 1 level, if you have a stope hang up, that creates an issue, right?
No, well, this is a different. It's a different scenario. What we do, we're not pulling from the stope. This is not. It's not a shrinkage. So this is Resu mining. So it's a bit different. So our stope opening is 4 feet wide. So we come into that stope, and our stope is, 500 feet long. We take 90 feet. We drill out 90 feet and we blast 90 feet, and we drill and blast the ore first. It goes down onto a conveyor belt, basically, a rubber that separates it from the waste below it. We take that, we slush it off down the mill hole and off to the mill. And then we come in, we shoot the waste, we roll up the conveyor belt, we shoot the waste, flatten it out, and then we stand on that waste and take the next shot and drill it out. So we're not drawing from the bottom of the, it's impossible to hang up the stope as such. The key is you have to drill blast muck that 90 feet a shift to produce 200.
Uh-oh.
Oh, it's not me.
Kevin, your webcam froze. Bear with us. Give it a little bit of time, but
Because I asked him a mining method question. Gary, are you still on the line?
Okay. Adam, why don't you tell us a little bit about underground mining, and I'll give Kevin a call. He's coming back on.
I am online here. Sorry, okay. I was on mute. It took me a bit to get on.
So anyway, Kevin's looks like he's gonna rejoin.
I'm gonna try and rejoin. Can you hear me?
Yeah,
we can. Excellent.
Okay, well, let's try it again. See if I can get back video.
We lost you about 30 seconds ago.
Okay. Okay, so we can. I can't see you, but you can hear me.
That's okay. Okay. We're wrapping up.
Great. So Kevin, let me shift from operations to exploration, and the areas that on the cross section appeared to the right, where you said that's where your primary focus, exploration focus is going to be. I believe that was actually to the west. It's to the west. Do you guys have some widely spaced holes there that indicate, good grades or continuous grades, and widths from the main ore body?
No, it's practically impossible to drill from surface. So we don't have any holes. We do have some surface sampling as you go further to the northwest. But no, we don't have any holes down there at all, and it's really not possible to or practical to try and do it from the surface. So this is why we wanted to drift out on that vein and then get ourselves in a position, where we can come off the vein and get into either the hanger wall or footwall and put a drill station in and see if we can poke some holes. But right now we don't. All we know is that we can see the vein on surface. And we, as I said, we have some samples, but we don't have any other data.
Yeah, I'm sure the market will have a lot more confidence in your mine life expansion when you've drifted out and can show, at least with widely spaced drill holes, that it looks like everything is relatively continuous to the west there.
Yeah, obviously we would too, of course. We're right now we're pretty big believers. But we have to demonstrate, of course. You're absolutely right that the numbers are really there.
And I guess sitting between, maybe more of an operational question. And I apologize if we talked about this the last time. I just can't remember. But the underground, the internal shaft from the old operations to the east. Can you guys take out that shaft pillar?
We've looked at that. Right now, we've got I forget what our zone is around that. One of the, we've not looked at really taking that out just yet. That might be something we do before we left the, the Mahogany Ila claim and went down below. But one of the things we have been looking at there was actually going through those old workings out to the south and accessing those areas out there, because out there we've got a lot of information from the old assays and whatnot that was done, and work that was done in the late part of, or the early part of the last century kind of thing. The vein, it's quite prolific. The silver grades are in the hundreds. There's even, you know, half an ounce per ton gold kind of thing out there, but we haven't really looked at trying to take out that pillar, Adam.
And then shifting again, Kevin, to marketing terms. You said that Trafigura is going to pay you 95% of the value of your concentrate at the mine gate.
Correct. Yes.
That I'm assuming that is including or factors in the impact of smelter charges, payable rates, and you know, and spot prices. Or maybe you could give us a little more detail on that, and how sensitive, or how, maybe not sensitive, but you know, how exposed are you to those factors?
Well, we'll get paid 95% of the value of that concentrate based on, you know, the prices. I can't exactly remember the terms of it, but it's LMB prices at that particular time. And the last 5% is on settlement from the smelter. And there's terms on the quotational period and whatnot. Yeah, but the payability of, yeah, that's all built into the, you know, into the 95%.
Right. So at 100%, you know, that's the revenue that would be contained, less the smelting charges and the payable rates and whatnot, and then you get 95% of that.
Yeah.
Just to be clear, but Trafigura is not going to. Is there also? Are you all? Is that 100% also discounted on Trafigura's transportation costs?
Yeah, there's transportation costs all built into all of those economics, insurance, transportation costs, everything is built in.
So somehow you guys have settled, you know, a transportation cost, despite the fact that they can sell it anywhere they want, and would then incur different transportation costs depending on where they were selling.
Yeah, it's there's options. I mean, we have to decide where it's going, and based on those, you know, whether it's China or to Trail or to Noranda or something like that, the transportation costs are based on the specific site.
Gotcha. Interesting. Okay. I was just curious how that would work. And then shifting again, Kevin, I'm really trying to keep you on your toes to Shafter. You know, I remember that deposit. I remember, you know, it couldn't work at, you know, as it was known 10 years ago at those silver prices. And so my question is to you, what has changed about Shafter? Is it purely the silver price, or is it a combination of silver price and new knowledge about the resource?
It's a different ore body. We're not going anywhere near where Noranda or where Aurcana tried to mine previously, and they were basically just doing remnant mining. The intention at that particular time, as I understand it, was to go to the same ore body that we're now intending to mine, which is the Goldfields side, which is pristine. It's never been mined. Goldfields did the work there in the 80s, did a feasibility study, and you know, we're going to put it into production kind of thing. But we're not looking to go back and try and do any other remnant mining that Aurcana previously broke their pick on. This is an underground mine. It's a Manto style ore body, fairly flat lying. We think open to room and pillar mining. Might even be open to continuous miner mining kind of thing. There's a few things we need to do, but there's a Goldfield sunk a shaft. So there's a shaft there right now with a head frame and a hoist. It's down 1,000 feet. The ore body, the bottom of the ore body as we know it today is around 900 feet. So they did about 5,000 feet of underground development and did a lot of drilling from underground, took a 10,000 ton sample and did metallurgy on it. And that's the data at which we're looking right now. And we want to do another little bit of drilling, but we think we can expand it on the fringes a little bit. We're not going to double it, but we think we can expand it on the fringes. And we want to do some drilling to get metallurgical sample to do as part of the feasibility study. But this, just to be clear, this is not remnant mining that Aurcana did before. This is a pristine ore body, never mined, and that's what we're focused on.
And that existing shaft and hoist and whatnot, that's all in good condition, or is that going to require some significant CapEx, to get into the condition, modern workable condition?
Yeah, I mean, we would have to rehab the shaft. We have to dewater. We'd have to look at the hoist in relative to today's technology. The last time I had it evaluated to put it back into service, it's quite a ways back, but it was about $500,000 to upgrade the hoist itself. And I can't quite remember what the rehab cost was on the shaft, but it was, it's fairly substantial amount of money. But it's the hole is in the ground. It's a timbered shaft. I suspect, off the top of my head, you'd probably be looking at somewhere between $5 and $7 million to get it up and running again in that vicinity.
Mm-hmm. Mm-hmm. And then could you use the existing, or is there existing above ground milling capacity and whatnot for that ore?
Yes, there's a mill there, fully permitted mill. It's 1,500 tons a day. It's too big, but that's easy to deal with. It's a cyanidation mill with a Merrill-Crowe finish to it, dry stack tailings, and so on. And we've just kept it on care and maintenance. It's been sitting there since November 2013. There's a little bit of work to do there, but not a lot of work.
Have you guys put out a resource on that new ore body in isolation?
No, and this is what we're in the middle of doing right now. I've got our head geologist here and a couple of other guys looking at, and we hope to have a new resource out on this particular area, imminently. Within the next month, kind of thing.
Are you going to follow that with a PEA maybe, so that we can get a handle on the potential economics?
No, our thought, we've already, we've got a PEA, but we're probably going to go right to a feasibility study in the new year.
You got it.
Pardon me?
You got an internal PEA?
We had one done by, but it's not on this particular ore body. The PEA that's out there right now is on the same ore body that Aurcana tried to mine previously in the Presidio area. But we're looking at doing a feasibility on this new Goldfields deposit. So we probably won't go to a PEA. We go directly to a feasibility study.
And could we assume that all the the mining costs, the processing costs are going to be effectively the same as as that old PEA? I mean, you're not accessing it the same way, but per se, but and what how would you compare the potential costs?
I don't see any difference in the milling costs. I would dare say that milling costs are not, it really isn't going to change with the going to this ore body versus the old one. So I think the milling cost that's in the PEA would be still good numbers. The mining cost in this new ore body, I would anticipate them.
You don't know your mining method yet, so you can't really say, right?
Exactly. But I mean, if you look at room and pillar versus conventional mining that Aurcana was trying to do in its previous life down there, I would hope that the room and pillar would be lower than the conventional mining.
What were they doing when you say conventional mining? What were they doing? Open stope?
Yeah, they were doing open stope. They had some big equipment there, but they were also doing a fair bit of jackleg, just trying to pick some high grade stuff. So really not well thought out in that previous life. And again, they started it off back in 2012 based on a PEA, right, which is a recipe for failure.
Any thought at this point if you guys would contract mine it?
No, we haven't thought about it. We've got a great selection of miners here in Revenue-Virginius, and one of the things that we kicked around. I mean, this is very early days yet, so this is all just ideas. Is that we might be able to cycle our miners through here, down there for a stint, and back up, kind of thing. So we've got a lot of work to do yet on Shafter, but.
Yeah, it's in the middle of nowhere. Colorado's much prettier than West Texas, I'm afraid.
Oh yeah, that's for sure. Yeah.
All right, let me throw it back to Campbell if there's more questions from the audience.
Okay.
Excellent.
Campbell, there you go.
There are no more questions from the audience. I think between the questions sent in and Adam's grilling, we've covered this thoroughly, and looking forward to a webinar in maybe October, November, when we can hear even more progress. And with that, I want to pass it back to you, Kevin, to close us. Thank you, everyone, for joining, and please share your feedback on your way out or in an email. Thank you. Well,
thanks, Campbell. Very much appreciated, everybody. Probably the last thing to take away from this is that we are in production. We're commissioning right now, and we'll be in production very, very soon. So might be a good time to look at Aurcana if you are interested in precious metals. Anyhow, thank you once again, and good luck to everybody.
Thank you. Bye.
Thank you.
Bye-bye.